Good morning, everyone. My name is Vipal Balian, and this presentation is based on evaluating the effectiveness of green bonds in reducing the corporate cost of capital. In this study, I will explore whether issuing green bonds provide companies with a measurable financial benefits, specifically whether they help reducing the cost of capital through lower yield bonds. Study overview. The core idea behind study green bond is to raise capital for environmentally beneficial projects. They have grown in popularity, but the key question remains. Do do green bonds result in cheaper financing for the companies that issue them? This study investigates that the companies comparing the green bonds with the conventional bonds, focusing on their yields and pricing behavior in the secondary market. Growth of green bonds in sustainable finance. Green bonds has become a major financial instrument in global market. Since their introduction, the market has expanded significantly, crossing over $2 trillion in total insurance globally by 2024. The rapid growth reflects strong investors' demand for sustainable investment. However, it's still unclear whether this demand leads to lower financing costs to the issuer. Let me discuss it further. So, the market uncertainty. Despite growth in volume, academic evidence of pricing advantage in green bonds is mixed. Some studies find green bonds trade at slightly lower yield, called as premium, while often find it's no significant difference. The uncertainty creates a dilemma for companies considering whether to issue green bonds purely for cost-saving reasons. The three key research objectives for the green bond. This study has so my main motive is comparing the green bond versus the traditional bonds on their yield characteristics. Use the match pair and OLS regression method to approach a pricing difference. Identify structural factors like coupon rates, maturity that influence yield. Evaluate whether the green label alone explains lower yield beyond financial features. My dataset. My datasets include 1719 bonds, 845 greens, and 874 conventionals. The dataset, each bond was analyzed based on the yield to maturity, coupon rate, time to maturity, issue size, and the sector. The data was clean for outliners and tested for normality, stationary, and correlation to ensure validity modeling. Two-step empirical approach. So in my methodology, I use two-step empirical approach. First one is OLS, and the another one is match pair method. In this match pair analysis, which pair green bond with the in which we compare green bond with conventional bond with the similar in credit ratings, currency, maturity, and issuer time. While the second, the Euler simulation model, where the dependent variable is yield to maturity and independent variables are uh, coupon rates, maturity, issue size, and the green flag dummy indicates whether it's a green bond or conventional. The slide initial finding supports green existence. Initial descriptive statistics shows that the green bond tend to have slightly lower average yield than the conventional bonds. This was especially notable in countries like Singapore and Germany, suggesting that market structure and region investors' preference may influence price. So my first one is match pair analysis shows small effect. The effect this match pair analysis produces a small negative yield difference. A green bond has slightly lower yield, around 0.07%, lower than the match conventional bonds. However, this result may not be statistically significant, meaning we cannot confidently conclude a strong pricing advantage using this method alone. While the another one is regression model. In this regression model, the green flag variable had a coefficient of minus 0.23%, indicates the green bonds are associated with 0.23% lower yield on average. Yet again, the result is not statistically significant with R. So that's why control variables like coupons and maturity behaved as expected. A higher coupon and longer maturity were associated with higher yield. Small but insignificant pricing. Both models shows a small premium, but it was not statistically significant. This suggests that green bonds do not consistently lower corporate cost of capital. In practice, pricing appear to be driven more in structural bond features than the environmental label alone. In conclusion, I would like to say green bond do show slightly lower yield, but the difference is minimal. There is no strong evidence of statistically meaningful green yield. For issuers, this means that the decision is issue green bonds should be driven by reputation, investors' engagement, and sustainability goals, not cost saving alone. What are the limitations? And for this and the future plans, the limitation include regional data, variability, regularity difference, and the market volatility. This factor impacts the consistency and comparability of the finding across different markets and jurisdictions. Methodology approach must account for these variations to ensure robust conclusion for can be applied across divergent business environment. Future research should study external review impact, study references, and policy effect on sustainable performance and reporting outcomes. There is also potential to explore the growing importance of green certificate standards and how they influence corporate behavior and stakeholder perspective. And that's all for today. Thank you so much.